Imagine sending 25 lakh rupees out of your account in India to fund an investment abroad, only to discover that 5 lakh rupees was instantly deducted at the bank counter before the money ever left the country. No prior warning, no tax default on your part, just 20% of your hard-earned capital frozen inside the Indian tax system for over a year. If you are a non-resident Indian living in the GCC, whether in Dubai, Riyadh, Doha, Muscat, Kuwait City, or Manama, this is not a hypothetical scenario. It is happening right now to thousands of professionals and business owners. Due to India's tax collected at source rules under Section 206C, 1G. At EPK Capital, we build wealth for generations. Over my 20 years managing cross-border wealth, I have seen brilliant investors build substantial assets, only to lose momentum to silent operational leaks. Today, we are breaking down why GCC NRIs fall into the TCS trap, how to fix it, and how to stop your capital from getting stuck in tax refund queues. Make sure to stay till the end for a special surprise that I have for you. And if you happen to like the content of the video, please do like and share the video. Also, do subscribe to our channel. Let's start with what TCS actually is, because it is widely misunderstood. Tax collected at source is not an additional tax on your income. It is an advanced tax collection mechanism that Indian banks are legally mandated to enforce on foreign exchange transactions. Indian tax regulations state that foreign outward remittances made through resident pathways exceeding 10 lakh rupees in a single financial year attract a 20% TCS on every rupee remitted above that 10 lakh threshold. For example, if you remit 35 lakh rupees out of India through a resident channel, the first 10 lakh rupees is exempt from TCS. The remaining 25 lakh rupees attracts a flat 20% deduction. That leaves 5 lakh rupees sitting in the government's hands as a tax credit. Why do GCC NRIs get caught off guard? Because most assume their global income is tax exempt. But bank remittance engines do not analyze your personal story. They follow strict code algorithms. If the transaction triggers the rule, the deduction happens instantly. The root cause of almost every TCS trap we clean up at EPK Capital comes down to one simple oversight: holding regular Indian resident savings accounts after moving abroad. Under the Foreign Exchange Management Act, or FEMA, the moment your status changes to a non-resident, keeping a regular resident savings account is a regulatory violation. When you initiate an outward remittance from a resident savings account, the bank processes it under the liberalized remittance scheme known as LRS. LRS is precisely where the rules apply. If you route those exact same funds through a properly converted NRO or NRE account using designated NRI repatriation routes, the LRS TCS rules do not apply. Holding an unconverted resident account literally invites the bank to deduct 20%. This brings us to what I call the zero tax jurisdiction paradox. If you reside in the GCC, your personal tax environment locally is zero. You don't file complex returns in Dubai or Riyadh. Because TCS is technically an advanced tax, it is credited to your Indian tax profile under Form 26AS. You can legally claim every single rupee back if you file an Indian income tax return. You have essentially granted an interest-free loan to the tax department, while your liquidity sits trapped instead of generating wealth for your family. Now, what about funds you legitimately earn in India, like rental income or share proceeds? Under FEMA, NRIs can repatriate up to $1 million per financial year out of NRO accounts. So why are so many GCC NR is still seeing 20% debited? Because of missing documentation. To move money without TCS, your bank requires two critical filings: 15CA and 15CB. Form 15, CB, a certificate signed by a CA. Form 15, CA, an online declaration. If your bank officer processes your transfer without these, the automated software defaults to standard LRS. The situation gets drastically worse if your tax infrastructure in India isn't updated. If your PAN status in the tax portal shows as inoperative, higher penalty rules kick in. If an inoperative PAN is flagged, higher tax rates apply automatically. The system rejects your refund claims automatically. You end up spending months navigating tax notices. Let's look at what this tax drag actually costs you over time. In wealth management, the cost of an error isn't just the money missing today. It's the lost compounding interest over the next decade. If you have 10 lakh rupees sitting in a tax refund queue for 14 months instead of being invested in a portfolio compounding at 12%, you lose over 1,40,000 rupees in immediate returns. If this capital lockup happens periodically, the lost compounding returns over a 10-year horizon can comfortably cross 30 to 40 lakh rupees. That is real wealth leaving your family. Building generational wealth requires securing the pipes through which your capital flows. Here is the 4-step execution blueprint every GCC NRI should implement immediately. Step 1. Convert your accounts. Audit every relationship. Reclassify to NRO/NRE. Step 2. Fix your PAN status. Confirm it is active and tagged under non-resident status. Step 3. Protocolize repatriation. Use the $1 million route with 15CA/CB. Step 4. Audit your cross-border structure. Ensure your portfolio and tax profiles are unified. If you are a GCC-based investor looking to review your cross-border wealth structure, our team at EPK Capital is here to help. Click the link in the description to schedule a private audit. Now, as a bonus, I have created an in-depth guide. You can download it by clicking the link in the description. Hit the like button, subscribe, and share. I'm Kunal from EPK Capital. Keep your capital working where it belongs.